Hi, my name is Thandisizo Mahluchana. I'm the Manager for Stakeholder Business Development at PPS Investments. And today I'm joined by David Crusoe. He's the Executive for Research and Investment at PPS Investments. And we're talking about the local and global economy in 2015, looking at what the interesting themes are. And David, thank you for the chat. One of the most important themes of 2015 is the fact that everyone is waiting for the US to raise interest rates. At what point can we actually realistically see interest rates going up in the US?
That's the million-dollar question, and unfortunately we will probably only know that when we actually see it happen. The market was expecting the US to raise rates maybe in June this year, but the guidance the Federal Reserve has given us so far this year at its January and March monetary policy meetings, as well as the strong US dollar, has indicated they might only raise rates in September or even later. There's no consensus on this at the moment, though, and it's a pivotal event, and financial markets will react to it when it happens.
How do you think world markets or markets around the world are positioned to absorb this increase in interest rates?
We still have a lot of debt in the global system, and we still have weak economic growth, particularly outside the US. So any prospect of increasing interest rates is quite a challenging one for most financial assets. And when it does take place, it's going to cause significant readjustments in terms of how these assets are priced, particularly if the economies remain as weak as they have done so far.
There's a report that came out recently, I think McKinsey it was, and it showed that over nine countries in the world have debt to GDP ratio of over 300%. Why has the world become so indebted over the last 7-8 years?
So government taking on more debt is one of the reasons why there's more debt. Corporates have been able to deleverage. So most corporates around the world have less debt today than they did in 2007. The really surprising outcome from the McKinsey study, however, not only that some countries had more than 200-300% GDP debt, was that I think 80% of the countries that they surveyed, the household had more debt today than they did in 2007. And that's the real challenge for the global economy. Households still have too much debt, and that's causing economic growth to be very weak because households aren't being willing to spend. And households haven't been able to deleverage their debt significantly because they haven't been receiving real income increases. Our government debt, though, has deteriorated quite significantly since 2007 and 2008. And the challenge facing South Africa, because we're such a small open economy, is that government debt can get unsustainable quite quickly. Most commentators think if our debt to GDP level goes past 60%, we're in serious trouble. And in fact, anything below 40%, more than 40%, will place us under undue stress. And our debt today, if we include the government guarantees to Eskom and the other parastatals, is uncomfortably close to 50%. So although compared to most economies we don't look too bad, we're very vulnerable because firstly our government debt is relatively high, and secondly our current account deficit, which is basically the difference between what we export and what we import, is uncomfortably large.
Let's chat about growth expectations in South Africa for 2015.
In terms of our growth rate, you will know that in 2014 we only grew at 1.5%, which is a very low growth rate and a long way off the 5% growth rate we need to start making an inroad into youth unemployment in our economy. Unfortunately, because of Eskom, because of our electricity constraint at Eskom, it doesn't look possible for us to grow more than 2% this year. Typically then, after such a poor 2014, we would have a bounce back in 2015 if we didn't have strikes, etc. But because of Eskom, it looks like we're not going to be able to grow by more than 2% in 2015. And that's quite disheartening, and that forecast is likely to stay in place for at least 3 or 4 years. So really, until 2020, it's going to be very difficult for our economy to grow more than 2% per annum.
How did our equity market and our stock market perform in the first quarter of this year, David?
The market got more expensive. So in rand terms, we've continued to have strong performance from our equity market, although it's been particular sectors and not the whole market. Interest-sensitive shares like property in particular have done well, and other parts of the market less so. Even though we've had performance from our market in rand terms, if you convert it into US dollars, it's looked less impressive because the dollar's been so strong.
So in light of the uncertainty surrounding US interest rates and when they're going to be raised, our own interest rates and when they're going to be raised, the low oil price, resource stocks have not turned and we don't know when they might turn. How are investors in PPS Investments protected, and how are their portfolios positioned to make sure that all of this uncertainty is well accommodated for and that investors' money is essentially going to be protected against losses?
Well, Thandisizwe, I'm glad you asked that question because that talks to the heart of our research process. So we're a multi-manager, and that means we try to diversify those kinds of risks. So we diversify across different managers and we diversify across different asset classes. And the reason we do this is because the future is uncertain, and the more diversification we have, the more likelihood we will be able to deliver consistent returns to our clients.
Now, in closing, what is our ultimate view in terms of expectations for financial market performance this year?
Financial markets will struggle to generate inflation-beating returns, particularly equities. And the reason we say this is because on a valuation grounds, the markets look expensive. And even the offshore markets are no longer looking inexpensive, particularly if you look at the United States. So we think it's going to be a challenging environment for investors. So how we've gone about structuring our portfolios is to firstly be overweight cash, because we think that will offer a better return if interest rates increase, and to remain fully invested offshore because we think the rand is likely to stay weak in this environment. But finally, and probably most importantly, we've been quite deliberate about investing with managers who can construct portfolios that look very different from the benchmark and who tend to have a focus on generating real returns. So what these managers tend to do is not chase the momentum in the equity market. They'll tend to underweight the shares that look very expensive and have done well, and they'll back their convictions to invest in less favorable parts of the market. And this really, on the medium-term view, which is the investment horizon we have for our portfolios, is, we think, the most sensible way to generate real returns for investors.
That's David Crusoe, Executive for Research and Investments at PPS Investments, talking about our latest views in our investment perspectives of 2015.